Hello everyone, welcome back. This is the second video on inventory systems. I'm going to cover inventory losses and insurance claims. So if stock is damaged and you are insured, insurance will pay out according to the agreement that you have with the insurance company. So we're going to look at the recording of transactions that relate to inventory losses, insurance claims. Inventory losses, insurance claims, and the calculation of gross profit will also be demonstrated. So I'm also going to look at how to calculate gross profit in the perpetual inventory system after we've had a look at insurance claim transactions. So it says here, record the following transactions in the General Journal of Calibu Education. So number one, Calibu Education was not insured for computer tablets being destroyed, and there was a leaking geyser above the storeroom. So 2,600 Rand was the cost price of the stock that was destroyed. Now in this case here, Calibu Education was not insured. So how do we deal with that transaction? There, just in the red, inventory losses and insurance claims will also be demonstrated here. That's what I'm doing. The amount of cover depends on the agreement with the insurance company. So our first scenario is the fact that we weren't insured and stock to the value of 2,600 at cost price was destroyed. It's actually quite an easy transaction. We open up a new account. This one we're going to call inventory loss. You can call it stock loss. I've seen that before. But the important thing, that account is treated as an expense. And a stock loss or inventory loss is an increase in expense. Therefore, the account will be debited. Inventory is credited as the value of our stock has decreased by the amount of the stock that was destroyed by the leaking geyser. So we debit inventory loss and we credit inventory 2,600. This year is done at cost price. And there's the narration, the little story that goes in the General Journal to tell you more about the transaction. Inventory destroyed due to geyser leak. So scenario number one, there was no insurance. Now we're going to look at number two. Calibu Education was insured with FNB insurance brokers. Stock with a cost price of 10,000 was destroyed. According to the insurance agreement, FNB agreed to pay 80% of the loss at a future date. So now we're covered for 80%. And if we look at the accounts that were debited and credited, FNB insurance is debited. They haven't paid us yet, so it's similar to accounts receivable, and they're going to pay us at a future date 80%. 80% of the stock that was lost, or the 10,000 Rand was the value of the stock that was destroyed. They're going to pay 80% of that at a future date is 8,000. So the loss in our books is the difference between what's going to get paid out and what we lost, the 10,000. 10,000 minus 8,000 is 2,000. Inventory loss, remember, increase in expense. FNB insurance, increase in assets, a current asset. FNB insurance is going to pay us, accounts receivable. And then we lost 10,000 of stock. Decrease in assets, credit. There we go. FNB covered 80% of the loss, and they're going to pay us at a future date. Right, number 3. Calibu Education was insured with FNB Insurance. Stock with a cost price of 12,000 was destroyed according to the insurance agreement. FNB paid 60% of the loss 1 week later. So stock with a cost price of 12,000 was destroyed, covered for 60% of the loss, going to get paid at a future date. So the inventory loss was 12,000. Let me repeat that. The value of the stock that was destroyed was 12,000, because they say the cost of the stock that was destroyed was 12,000. So decrease in assets, credit 12,000. FNB Insurance is going to pay 60% of the 12,000, which is 7,200. Accounts receivable, increase in assets. So the loss was the difference between the 12,000 less the 60%. So 40% is a loss, which is 4,800. It's debited because that's an increase in expense. FNB covered 60% of the loss, and they're going to pay us at a future date. When they do pay us, FNB, we are going to debit bank, increase in assets, 7,200. So there's the 7,200 that they owe us because we're insured. They pay us, excuse me, we debit bank, and do they still owe us? Decrease in assets, FNB Insurance, credit 7,200. So 7,200 was debited, FNB Insurance. Now they pay us, and we go and credit FNB Insurance. It's an asset swap. What happened was cash at a future date, FNB Insurance became cash when they paid us. So there we've recorded that our bank balance increased by the payout amount, 7,200. So first of all, the promise was to pay us, and then they paid us, FNB Insurance. There we go. Right, number 4. Calibu Education was insured with FNB Insurance Brokers. Stock with a cost price of 16,000 was destroyed. 16,000 cost price destroyed. According to the insurance agreement, FNB would cover 100% of the loss. 50% is to be paid out immediately, and the balance at a future date. Loss 16,000. Covered 100%. 50% going to be paid out immediately. Now, you want to have a record of your insurance company, FNB Insurance, what they've agreed to pay us. Even though they're paying us some money, they say immediately 50%. So let's have a look. FNB Insurance, we go and debit with the full amount because they're going to pay us 100%. We want in the FNB account the full amount, 16,000. Even though they pay us 50% immediately, we want to show the full amount that FNB have agreed to pay. So then the FNB account is 16,000. And what happened to our inventory? 16,000 Rand cost price of inventory was destroyed. So inventory decrease in assets, credit 16,000. Now FNB pay us, at a future date. So, no. F&B paid us immediately, but I first recorded the full amount in this account, the F&B account. So now we receive the money, bank is debited, and F&B is credited with 8,000. Now what's nice is we have a record of what F&B agreed to pay, what they have paid to date, and if you balance this F&B account, 8,000 is still outstanding. So if there is some sort of problem, we know that F&B still owe us another 8,000, which they will pay us out at a future date. So we record the full amount, the 16,000, then the receipt of 50%, and in the future we're going to get another 8,000. Then the balance of this F&B account insurance will be 0. So I would expect if you get asked this in a test, you would get the general journal and you would have to record the transactions, either like number 1, 2, 3 or 4 different scenarios. Fully insured, paid out 50%, paid out 100%. One of the different scenarios with regard to insurance. Right. Let's have a look at another little section part of perpetual. That was insurance claims. Now I want to calculate the gross profit to finish off this perpetual inventory system. Now with perpetual it's quite easy because you have the sales figure less the cost of sales. But don't forget about the sales returns, because sales returns will make that sales figure smaller. This sales amount that I'm showing you, 159972, includes cash and credit sales. So you're going to have all sales less sales returns minus the cost of the sales, and that will give you the gross profit in the perpetual inventory system. Now what I've done is I've taken an extract from that trial balance I just showed you, and there's the sales figure, there's the cost of sales, there's the sales returns. So we've got sales minus, I'm going to just say take off the sales returns, let's call it sales returns less cost of sales. So sales is 159972, 09. Sales less the sales returns, there's the sales returns, 3456, there it is, sales returns, less the cost of sales, 113467 and 53 cents is going to give you the gross profit in the perpetual inventory system. I can put this in brackets, that means subtract. And if you do the maths there, let me quickly do it in my head. 1599720024561134667. Okay, I see. 43048 comma 56, if my mental maths is correct. You can check it. Now this is the perpetual inventory system. Cost of sales is calculated after every single sale. In the periodic inventory system, which I'm going to start covering in the next video, there is a formula for cost of sales, and it's opening stock plus purchases plus carriage inwards plus a few other costs less closing stock, and that's going to give you the cost of sales. But we're going to have a look how to deal with that in the next video. So perpetual, you calculate cost of sales after every single sale. They normally give you a markup on cost price as a percentage, 30%, and you do the maths. In this periodic inventory system, at the end of the period, you're going to use a formula to calculate cost of sales. So in the next video, I'm going to do the periodic inventory system, and we can make a comparison now that you have all the knowledge with regard to the perpetual inventory system. You're still leaving a footprint after the inventory system. You would have left some fingerprints in your textbook. We will chat soon in the next video. I look forward to doing the next video. Cheers for now.